Welcome to the deep dive. Today, we're focusing on a really critical player, maybe one that flies a bit under the radar sometimes, EMCOR Group Inc. That's ticker EME. They're basically building the power infrastructure and the mechanical nervous systems for a lot of the modern U.S. economy.
Yeah, exactly. And for decades, EME was kind of seen through this very narrow lens, just a cyclical construction stock.
Right, tied to the ups and downs of commercial real estate.
Totally. Highly vulnerable to those booms and busts.
Yeah.
But looking at the source material we have, it's clear a pretty profound shift has happened. They've really strategically repositioned themselves. It's not just construction anymore. They're a premier specialty contractor
Yeah.
and a facility services provider.
And operating right at the heart of these huge megatrends, right? Infrastructure, AI, domestic manufacturing.
That's the spot,
Yeah.
right at that intersection.
So that transition, that's really the key story we want to dig into today. Our mission is to get a solid understanding of how management actually engineered this re-rating of the company. What are the specific financial drivers behind this record performance they've been having? I mean, how do they basically double their historical profitability? That's huge.
It really is. And just as critically, we need to look at the risks. What are the structural challenges? Things like labor shortages, supply bottlenecks. Are they threatening this new impressive margin profile? Can it actually last?
Yeah, that's the big question, which leads to the ultimate investment dilemma for you, the listener. EME's results, they look stellar. The backlog is massive. But, in this market, is all that success already fully baked into the price?
That's the core debate. We really need to dissect the operational side, the financial data, and figure out if the runway ahead justifies the, frankly, premium valuation it has now.
Okay, let's start right at the beginning then. Segment one. Defining EMCOR's core business, how they operate, and then get into these compounding megatrends that are feeding this incredible demand.
All right, so EMCR's operational DNA, if you will, it's built around this resilient hybrid business model. And that structure, fundamentally, is what sets them apart from just a pure-play construction company.
Hybrid meaning two main parts.
Exactly, two major interconnected lines of business. So on one side, you've got the big project-based stuff, construction operations. This is the highly specialized technical work, installing complex electrical systems, mechanical systems for huge facilities. Think data centers, big hospitals, advanced manufacturing plants.
Okay, the big builds and the other side.
That's the crucial stabilizing factor.
Yeah.
The facility services division. This piece provides a steady, recurring revenue stream. Once EME builds something complex, they often lock in long-term contracts to actually operate it, maintain it, service those systems over the building's whole life cycle, keep it running smoothly.
Gotcha. Design, build, and maintain.
Precisely. Now, to give you a sense of the scale here, they break their work down into 5 reportable segments. You've got the specialized ones, U.S. Electrical Construction and Facility Services, and then U.S. Mechanical Construction and Facility Services.
So electrical and mechanical, the core engineering parts.
Down to the engines, yeah.
Yeah.
Handling the really complex installations. Then you have segments that are maybe a bit more defensive. U.S. Building Services, that covers everything from HVAC repair, commercial site maintenance, general upkeep, and U.S. Industrial Services, which caters to heavy industrial clients, like refineries or power plants.
Okay. And there was a UK piece, too.
There is, yes. UK Building Services. But as we'll get into later when we talk strategy, that segment is actually pending sale right now. They're focusing domestically.
Makes sense. So how does the revenue actually break down? Where's the focus?
Well, the revenue mix is really key to understanding management's strategy. In 2023, something like 97% of their revenue came from the U.S. Big domestic focus. And if you slice it by activity, construction operations, those big projects, made up about 63% of the revenue.
Okay, the majority.
Yeah, but then building services, that recurring maintenance piece, that was 28%. And that's the critical anchor. Industrial services made up the last 9%. So that 28% from building services, that's really the stabilizer against the construction cycles.
People often point to that 28% as, resilience. But how much protection does it really offer? I mean, construction can be brutally cyclical. If new projects just dry up, say down 30%, does that maintenance side truly keep the lights on?
Well, it doesn't eliminate the risk entirely, obviously, but it does mitigate it significantly. Think about the kinds of facilities they service, a semiconductor fab, a hyperscale data center. The maintenance contracts for those places, they're absolutely non-negotiable. Usually very high margin, too. You simply cannot let the power systems for an AI cluster fail.
Right. Downtime is catastrophic.
Exactly. So while the revenue from new projects might dip in a downturn, That highly technical essential service work tends to be incredibly sticky. It's mandatory. That insulates their bottom line much, much better than a company that only does new construction.
Okay, that makes sense. Now let's talk about the size of the playground here. These markets are huge, right?
Oh, absolutely massive. The U.S. construction market alone, we're talking projections around $1.77 trillion this year. It's enormous.
Wow.
And then the U.S. facility management market, that's another giant field. Estimates range from, say, $315 billion up to maybe $379 billion. Huge numbers.
So enormous markets, but you mentioned they're fragmented.
Very fragmented. You might think that means low barriers to entry, lots of small players. And there are, but that's actually where EME scale becomes this huge competitive advantage.
Yeah.
The ability to actually win and successfully execute those massive, multi-year, highly technical projects, that's restricted to a really small handful of companies.
Why is that? What keeps these smaller regional guys out of EME's sweet spot, those
Right.
really profitable projects?
It really boils down to about four main things. First, you just need substantial financial resources. You need deep pockets to fund these huge multi-year projects up front.
Okay, capital. What else?
Second, and this is critical, significant bonding capacity. Bonding is basically like a specialized insurance policy for the client. It guarantees that if the contractor, EME in this case, fails or goes bankrupt halfway through, the bond company will step in and make sure the project gets finished. For multi-billion-dollar jobs, only companies with exceptionally strong balance sheets, like EMEs, which gets called fortress-like, can even secure the necessary bonding. It's a huge barrier.
Okay, so financials and bonding. What are the other two?
Deep technical expertise, especially in that complex electrical and mechanical engineering. We're talking stuff that's frankly non-trivial for these AI data centers and advanced facilities. You need real specialists.
And the last one?
An impeccable verified safety record. For the biggest clients, especially industrial firms or government projects, a poor safety track record is an immediate disqualifier. No negotiation.
Oh.
So you put those four together: capital, bonding, expertise, safety. And it creates this really strong moat around that high-end, complex project market.
Okay, let's unpack this because here's where it gets really interesting. You've got this company with scale, with these barriers to entry, and now it's colliding head-on with like four massive secular trends. This isn't just a normal construction upswing.
Not at all. And we absolutely have to start with data center growth. This is largely the AI effect we're seeing. The projections are staggering. The global data center construction market is expected to almost double. It was around $241 billion in 2024, projected to hit $457 billion by 2030.
Wow, that's like an 11.8% compound annual growth rate. Explosive.
It is. And the reason this is such a gold mine for a company like EME is what's changing inside these buildings. It's not just more buildings. They are fundamentally different. Think about power needs. A traditional server rack might need, what, 2 to 4 kilowatts, maybe? Standard cooling.
Yeah, manageable.
But these new AI workloads, the heavy compute stuff, they're demanding 40 to 120 kilowatts per rack.
That's an order of magnitude jump per rack.
It's a staggering change in density. And it means you can't just, scale up the old design. The entire facility has to be re-engineered from the ground up. The sheer amount of electricity you need to distribute multiplies massively. You're moving from standard wiring to specialized heavy-duty busway systems.
Yeah.
You need huge redundancy. And critically, you got to deal with the heat.
Right. All that power generates immense heat. Traditional air conditioning can't cope with 120 kilowatts crammed into a small space.
Exactly. Forget about it. This forces a shift to really advanced mechanical systems. We're talking liquid cooling, sometimes even immersion technology, where components are literally bathed in specialized cooling fluids. And designing and installing those complex high-voltage electrical systems and these high-volume liquid cooling mechanical systems, that is EME's core specialty.
So the technical difficulty itself drives up the value.
Absolutely. It increases the complexity, it extends the project duration, and it allows EME to command significantly higher margins than they would on, say, a standard office building.
Okay, trend number 2, manufacturing, reshoring, and high-tech build-out. This is about bringing supply chains back home, right? Driven partly by government incentives.
Yeah, that's a big piece of it. You've got key legislation really pushing this. The THPS and Science Act, specifically, is pouring incentives into building massive new semiconductor fabrication plants, fabs, domestically. And you see similar pressures driving new factories for things like electric vehicle batteries, advanced life sciences, pharmaceuticals.
And the speed of this is just incredible. I saw in the source material, construction spending on U.S. manufacturing facilities jumped, get this, 71.3% in 2023 alone.
71%. It's wild. And these aren't simple warehouses. These are multi-billion-dollar, high-precision clean rooms, labs. They need incredibly complex HVAC, specialized piping, ultra-clean power systems. Again, right in EME's wheelhouse.
Okay, third trend, energy transition and electrification, this whole push towards decarbonization.
Right. This means the fundamental design of commercial and institutional buildings is changing. The goal is to create all-electric connected buildings.
What does that actually look like on the ground for a company like EME? What are they installing?
It means integrating a whole suite of complex technologies. You're talking about installing on-site renewable generation, like solar panels or even small wind turbines, building out extensive EV charging infrastructure, and, really importantly, deploying battery energy storage systems, or BES, along with microgrids. These are needed to manage the intermittent nature of renewables and ensure reliable power. All of this is highly specialized electrical and mechanical work. It creates this long-term, durable demand stream that should outlast any single construction or real estate cycle.
Okay, and the fourth piece is just the sheer amount of infrastructure spending providing a sort of safety net.
Kind of a demand floor, yeah. You've got massive federal programs like the Infrastructure Investment and Jobs Act, IIJA, and the Inflation Reduction Act, IRA. Together, they're committing over $1 trillion to modernize the electrical grid, transportation networks, water systems, and so on.
And while some of that goes to heavy civil guys building roads and bridges,
A huge chunk of the electrical upgrade work, the mechanical systems for facilities, the industrial upgrades that flows directly into EME's segments, it provides this government-backed demand, a backstop, even if the broader economy slows down.
okay, so if we try to connect all these dots, link this to the bigger picture, it really becomes clear why the growth isn't just fast, it seems to be compounding across their different business lines.
Exactly. That's the key insight. These trends aren't happening in isolation. They feed each other. The AI data center boom needs enormous amounts of reliable power. Well, that accelerates the need for energy transition projects, grid upgrades.
Which are supported by the infrastructure spending.
Right, and both the data centers and the new manufacturing plants, they benefit directly from government funding tied to reshoring goals and the GPS Act.
So let's take an example. A big tech company decides to build a new semiconductor plant, maybe encouraged by GPS Act money. EME could win big there, right?
Absolutely. Multiple opportunities from one project. First, they could get the initial high-margin construction contract for all the complex mechanical and electrical systems inside the fab itself. But then, they might also get the job to install the necessary battery storage system, maybe some on-site solar, to help power that energy-hungry facility driven by those energy transition goals.
And then the service contract afterwards.
That's the virtuous cycle. That single, huge, complex construction project often leads directly into a long-term, highly technical, and likely high-margin service and maintenance contract for those same systems.
Wow.
It dramatically multiplies the lifetime value of that customer relationship. And it significantly builds up and stabilizes that recurring revenue base we talked about, which in turn supports the higher valuation the market is giving them now.
All right, let's move into segment 2, because this isn't just about riding market waves, right? E&E has actively shaped its business to capture these opportunities. Let's start with their competitive moat, what structurally differentiates them and locks in those customers.
Well, their core advantage really comes back to that integrated full life cycle service model, especially for these really complex facilities. They aren't just showing up to build something and leave. They position themselves as partners right from the initial design phase through the construction and then sticking around for the long haul, operations, maintenance, upgrades.
And for those mission-critical places like a pharma lab or a data center, clients probably prefer that continuity.
Oh, absolutely. They want a single, trusted entity that deeply understands the intricate systems they installed, managing the entire life cycle. It reduces risk for the client.
And that hybrid model, we keep emphasizing construction plus services that provides the resilience. The construction side catches the high growth from these megatrends.
Exactly. Captures that velocity. Well, the building services segment, that steady 28% of revenue, provides the defensive annuity-like stream against the inevitable construction slowdowns.
Yeah.
The synergy here enables what they call a land and expand strategy.
Land and expand.
Yeah. You land the initial complex construction project, where those high barriers to entry we discussed keep out most competitors. You prove your expertise, build trust, and then you seamlessly expand that relationship into a long-term recurring maintenance contract. You essentially turn a big one-time project into a multi-year predictable cash flow stream.
Makes sense. Now, when we look across the competitive landscape, EME consistently ranks as a top dog in electrical and mechanical contracting. But who are they actually bumping up against day to day?
It's kind of a mix. They face a few distinct groups. You have direct specialty peers like Comfort Systems USA, ticker FICX. They operate in a pretty similar space, focused on mechanical and electrical.
Okay, direct competitors.
Then you have the broader utility and infrastructure players. Companies like Quanta Services or Mastech. EME might compete with them on some of the really large government projects or maybe grid-related work.
And the third group.
On the services side, they compete with the facility management giants. Think ABM Industries or the big building controls providers like Johnson Controls.
So it's a crowded field. What makes EME's position sort of unique within that mix?
I think EME's niche is really specializing in the highly complex in-building technical systems. So Quanta, for instance, might be more focused on the big power lines, the transmission infrastructure leading up to the facility.
Okay. EME takes over once the power gets inside the walls.
Pretty much. They handle the intricate guts, the electrical distribution, the specialized cooling, the complex piping within those hyperscale facilities, the hospitals, the labs. Their scale, that crucial bonding capacity, and their deep specialization in these M&E systems give them an edge over smaller specialty guys and lets them take on work that's maybe too specialized or complex, even for some of the broader infrastructure firms.
Okay. Now let's get into the really active steps management took. This wasn't just passive growth. They were deliberately engineering higher margins through active portfolio management.
Yeah, this is key to understanding the margin story. The biggest move, undoubtedly, was the acquisition of Miller Electric Company. That was all cash, $865 million, finalized back in February 2025.
$865 million. That's a big bet. What did Miller bring to the table?
It was highly strategic. Miller added about $805 million in 2024 revenue. The price paid, roughly 1.08 times revenue, seems pretty reasonable given the market and the asset quality, but the why is crucial. Miller Electric massively boosts EME's position, specifically in electrical construction. And that's the area seeing the most intense demand right now because of AI data centers and all the reshoring activity.
So they bought capacity right where the demand curve was steepest.
Exactly. Miller brought immediate high-quality electrical contracting capacity, deep customer relationships, particularly strong in those high-growth sectors like data centers and healthcare. It was like a direct injection of capability, right where the secular trends were hitting hardest.
So buying aggressively in the hotspot. But at the same time, they were also trimming the portfolio, right? A major divestiture.
Correct. That shows the focus. They announced the sale of their UK building services segment in September 2025. That part of the business did about $425.5 million in revenue in 2024.
And the logic there was lower margins.
Primarily, yes. The UK segment historically operated at lower margins compared to their booming US operations.
Yeah.
Shedding it sharpens their focus entirely on the more attractive, higher growth, higher margin US market.
So the financial rationale seems pretty straightforward then. Sell a lower margin UK assets, reinvest that capital, potentially, into higher margin U.S. electrical capacity like Miller. That has to be accretive to the overall operating margin, right?
Absolutely.
Yeah.
Management was explicit about it. They said the move was designed to sharpen focus on the high-quality U.S. market and is expected to boost the overall operating margin profile. This strategic one-two punch, buying high-growth, high-margin electrical assets while simultaneously selling lower-margin international operations, that's really the core engine behind the sustained margin expansion we're seeing play out in the numbers.
We should probably also mention the leadership transition. The longtime CFO, Mark Pompa, stepped down in April 2024 after, 30 years?
Yeah, long tenure. And he was succeeded by an internal veteran, Jason Arnell-Bandian.
Having that continuity, promoting from within, especially during such a dynamic period of growth and big M&A deals, that probably signals stability in their financial strategy to the market.
You'd think so. It certainly helps reassure investors that the aggressive but disciplined, growth-focused capital allocation approach is likely to continue without any major shakeups or disruptions.
Okay, so this strategy, fueled by megatrends, sharpened by M&A, it's undeniably showing up in the financial results. When we get into segment 3, the numbers really tell the story. It's not just growth. It feels like a fundamental change in the economics of how they operate.
Yeah, if you look first at just the top line, the revenue and profit trajectory, the growth has been really solid. Total revenues went from about $6.7 billion back in 2015 up to $14.6 billion in 2024.
That's roughly a 9% compound annual growth rate. Pretty good.
Decent, yeah. But 2024 itself was exceptional. Total revenue growth was 15.8%. And what's really telling is that 13.8% of that growth was organic.
Ah, so not just acquisitions driving it.
Right. M&A only added about 2 percentage points that year. That strong organic growth really confirms that the underlying demand from those secular trends we talked about, data centers, reshoring, is incredibly powerful on its own.
Okay, but the real headline here, the thing driving the stock's re-rating, is the margin story.
Absolutely. This is the single most important shift. Historically, EME was, well, a pretty typical construction services company. They operated with margins in the, say, 5% to 6% range. That was kind of the market's baseline expectation for years.
But now, with these complex, high-tech projects, the data center work, the strategic pruning, that picture has changed dramatically.
Completely. The operating margin hit a record 9.6% in the second quarter of 2025, and management's guidance for the full year 2025 is in the range of 9.0% to 9.4%. We're talking about nearly doubling their historical profitability levels. For a company doing nearly $15 billion in revenue, that kind of sustained margin expansion is truly transformative.
How confident can we be, though, that this 9–10% range is the new normal? Is it sustainable, or is it just a temporary peak because contract pricing is super favorable right now?
Well, based on management's commentary, they seem to believe it's structural, not just cyclical. They consistently attribute the expansion not just to higher volume, but crucially to the mix shift in their work. They're doing more of these high-specification, technically demanding electrical and mechanical projects. These jobs inherently carry higher margins because the technical barriers to entry are so high, limiting competition.
And selling the lower margin UK business helps lock in that higher base, too.
Exactly. It reinforces that higher margin floor. If you compare EME now to other heavy civil contractors or general commercial builders who often operate in maybe the 4% to 7% operating margin range, EME is performing at a genuinely best-in-class level. That performance absolutely justifies why the market is rereading the quality of this business.
And that operational success, those higher margins, they flow directly into really impressive returns on capital. It shows they aren't just growing the top line, they're deploying capital very, very efficiently.
Yeah, look at return on equity, ROE. It hit an exceptional 37.8% on a trailing 12-month basis as of Q2 2025.
37% ROE. That's incredibly efficient profit generation relative to shareholder equity.
It really is. And then there's return on invested capital, ROIC. That peaked at a huge 40.6% in December 2024 and was still a very strong 27.3% on a TTM basis recently.
Why is that ROIC figure so significant for a company in this sector?
Because ROIC measures the return they generate from all the capital they use, both debt and equity. Construction, generally speaking, isn't seen as a super high ROIC industry. A lot of competitors are capital intensive, maybe carry heavy debt loads. EME clocking in with an ROIC around 27%, that's substantially above the industry average. It signals they built a really high-quality, relatively capital-light, and highly efficient business model. They can generate great returns without needing tons of assets or leverage.
Okay, stellar performance, great returns, and this is all validated by maybe the most important forward-looking indicator for this kind of business, the backlog analysis, the remaining performance obligations, or RPO.
Yeah, and the backlog growth has just been explosive.
Yeah.
It really confirms the strength and durability of those megatrends. The backlog grew from $3.8 billion back in 2017 to an all-time record of $11.91 billion as of June 30, 2025.
$11.9 billion. What was the recent growth rate on that?
In the latest quarter reported, the year-over-year growth was 32.4%, just phenomenal growth in future contracted work.
A backlog that large, nearly $12 billion, gives investors incredible revenue visibility, doesn't it? It basically locks in a significant chunk of their top-line growth for the next, year or two?
Easily. At least 12, 18 months, probably more depending on project durations.
Okay.
And importantly, we need to look at the composition of that backlog. What kind of work is it?
Right. Is it the high-margin stuff?
Well, the source material strongly suggests it is. The growth is reportedly heavily concentrated in those key high-margin sectors. Network and communications, which is primarily data centers, high-tech manufacturing, and large institutional projects like healthcare facilities.
So the backlog is full of the exact type of complex, specialized projects that drove the margin expansion in the first place.
That's the implication. It strongly suggests that the higher 9–10% operating margin profile is likely already baked into a large portion of that massive $11.9 billion project pipeline. It supports the sustainability argument.
Okay, finally in this section, let's touch on cash flow and capital allocation. We established earlier it's not a very capital-intensive business model.
That's right. They don't need to spend massively on plant and equipment year after year. Their capital expenditures, CapEx, were only about $70 million in 2024. That's tiny compared to their operating cash flow, which was $1.41 billion.
So only about 5% of operating cash flow going to CapEx.
Exactly. And that low CapEx requirement means they generate tremendous free cash flow, FCF. They reported $1.34 billion in FCF for 2024. Just a cash-generating machine.
And this strong cash generation sits on top of that fortress-like balance sheet you mentioned. How strong is it compared to peers?
It's a huge competitive advantage. As of mid-2025, they were actually in a net cash position. They had $486 million in cash sitting on the books versus only $250 million in total debt.
Wow, more cash than debt.
Yeah. And their debt-to-equity ratio was super low, around 8.2%. This kind of financial strength gives them incredible flexibility that competitors carrying a lot of debt simply don't have.
And that financial firepower allows them to pursue their capital allocation strategy on multiple fronts at once, right?
Precisely. They have a balanced framework. They prioritize reinvesting organically in the business first. Then they look for strategic M&A, like the Miller Electric deal. And they still have plenty left over to return capital to shareholders through buybacks and dividends.
And we saw that play out recently.
Absolutely. In just the first half of 2025, they spent nearly $887 million on acquisitions, mostly Miller. But at the same time, they allocated over $432 million to repurchase their own shares, plus they continued paying their regular dividend. That's the definition of a financially agile company. They can fund aggressive growth and reward shareholders simultaneously without stretching their resources thin.
All right, but now we have to shift gears a bit. This amazing performance, this strategic execution, it doesn't happen in a vacuum. There have to be challenges, external pressures, operational hurdles. Every great story faces bottlenecks, and EME can't be immune.
No, definitely not. And this raises an important question, maybe the important question right now. Can they actually convert that massive $11.91 billion backlog into real free cash flow efficiently? Or are they going to hit some serious constraints?
And the biggest constraint everyone talks about for EME and the whole industry is skilled labor shortage.
It's the elephant in the room. The numbers are pretty stark. Our source material estimates the U.S. construction industry needed something like 439,000 new workers in 2025 just to meet current demand.
Almost 500,000 workers.
Yeah. And we're talking about a systemic shortage of the very people EME relies on most. Skilled electricians, specialized pipe fitters, experienced mechanical engineers, all critical for doing that high-margin technical work.
And that shortage causes two big problems, sir.
Exactly. First, obvious one, wage inflation. When skilled labor is scarce, you have to pay more to attract and retain workers. That puts direct pressure on those record 9–10% operating margins. Can they hold if labor costs keep rising?
And the second problem?
A serious constraint on growth capacity. It doesn't matter how big your backlog is or how strong demand is. If you simply cannot find enough qualified crews to staff the projects, you can't execute the work. You can't convert that backlog into revenue quickly enough. It becomes a bottleneck.
Okay, so labor's number one. On top of that, there are still supply chain issues lingering, although maybe they've shifted focus.
That's a good way to put it. It's not like the broad shortages we saw a couple of years ago with lumber or basic steel. Those have mostly stabilized. But the data center boom, in particular, has created new, very specific bottlenecks. We're seeing absolutely record demand and really extended lead times, sometimes over 2 years, for critical, highly specialized electrical gear.
Like what kind of gear?
Primarily things like large transformers and complex switchgear. These aren't off-the-shelf items. They're often custom-engineered and built for specific projects. The demand surge, especially from data centers needing massive power handling, has overwhelmed the manufacturers. These delays can really push out project timelines, potentially frustrate clients, and maybe even ding EME's reputation for reliable execution if they can't get the parts.
Okay, labor, specific supply chains. And we also just have to acknowledge the background risk, cyclicality and interest rates. Construction is, by its nature, cyclical.
It is. And if the Fed keeps rates high or raises them further, it definitely increases the financing costs for EME's clients. That can certainly lead to delays or maybe even cancellations for some projects, especially in sectors that are more sensitive to interest rates, like maybe speculative commercial real estate development.
But you argue EME is somewhat insulated from that typical cyclicality.
I think they are significantly insulated, yes. This is where their strategic focus really helps. Remember the composition of that huge backlog. It's heavily weighted towards projects fueled by federal funding infrastructure work, GHGA's Act manufacturing, or its hyperscale data centers for major tech companies. These are seen as must-build, strategically essential, long-term investments. These types of projects are far less sensitive to small or even moderate changes in interest rates compared to, say, building another strip mall or office tower. It provides a strong buffer against a typical commercial construction slowdown.
Okay, so acknowledging those risks, labor, supply chain, background rates, let's get to the absolute core issue for investors now. The valuation context, all these great results, the strategic wins, the massive backlog, it's led to a major re-rating of the stock. EME just isn't priced like an average cyclical contractor anymore.
No way. And that's the heart of the investment debate right now. Historically, EME traded at a pretty low PE multiple, maybe low double digits, typical for a construction firm. Today, its forward price to earnings ratio is way up there, trading in the, let's say, 25x to 28x range.
28 times forward earnings, that's steep.
It is. And look at another metric, enterprise value to sales, EV sales. It's running around 1.5x. That's significantly higher than its 5-year average, which was closer to 0.92x.
So the market is sending a very clear signal. We believe EME is now a fundamentally higher quality business, capable of sustained high growth and permanently higher margins.
That's exactly what the valuation implies. It assumes two key things are true going forward. First, that EME can keep delivering strong organic growth, driven by those megatrends. And second, crucially, that those elevated 9–10% operating margins are the new sustainable floor, not just a temporary cyclical peak.
But the risk is, at 28 times earnings, there's basically no room for error, is there? If something slips, if execution falters, or if those cost pressures like wage inflation push margins back down towards, say, 8%.
The stock could face a pretty significant derating. That's the danger of a high valuation. It prices in near perfection.
So the central question remains, has the market already fully captured this amazing transformation story in the current share price? Given that high multiple, what happens if they only manage to hold, say, 8% margins long-term, instead of the 9.5% or 10% that seems baked in?
Even that seemingly small difference, 150 or 200 basis points on the margin line, would fundamentally change the earnings power, the narrative, and almost certainly the valuation multiple the market is willing to pay.
Yep.
That's why tracking those execution risks, those potential margin headwinds, is absolutely paramount for anyone looking at this company now.
Okay. So to stay on top of this, what are the critical uncertainties that you, the listener, should be monitoring closely going forward? Our sources seem to highlight 3 main questions.
Yeah, 3 key things to watch. First, and most obviously, margin sustainability. We've talked about the structural reason why margins are high, the project mix, the technical complexity, the UK sale. But you constantly have to ask, will those cost pressures, especially wage inflation from the labor shortage or maybe increased competition, eventually start to erode that pricing power? Will margins inevitably drift back towards that historical 5–6% average? How strong is that competitive moat when it comes to maintaining pricing?
Okay, watch the margins like a hawk. Second key question.
Pace of backlog conversion. That $11.91 billion backlog is fantastic, but it only turns into shareholder value if they can execute those projects efficiently and turn them into revenue and ultimately free cash flow. So you need to monitor for signs of operational bottlenecks. Are projects getting delayed? Is working capital building up? A key metric to watch here is day sales outstanding, DSO.
DSO, how quickly they get paid after booking revenue.
Exactly. If you see DSO starting to creep up consistently, it could be an early warning sign. It might signal operational issues, maybe supply chain delays holding up completion, or even clients starting to slow walk payments. It tells you about the efficiency of converting that backlog.
Makes sense. And the third, critical uncertainty.
Resilience in a downturn. Okay, we argued their current customer base is pretty robust, less cyclical, but you have to stress test that assumption. How resilient would demand really be if we hit a broad, severe economic recession? Would those hyperscale cloud providers suddenly slam the brakes on their massive data center buildouts if their own revenue growth stalls? Would government infrastructure funding flows slow down if tax receipts plummet? You can't just assume any backlog is completely recession-proof. You have to constantly probe the durability of that demand floor. #tag outtrace floors.
Okay, so let's try to synthesize all of this, pull it together. The investment thesis for EMCR, it's definitely compelling and it seems very strategically focused. You have a company that moved decisively, the Miller acquisition boosting electrical, the UK divestiture sharpening focus, positioning itself perfectly, it seems, to capture these incredibly powerful, long-lasting megatrends. AI data centers, the energy transition, high-tech reshoring here in the US.
And that strategic pivot, combined with strong execution, has delivered really tangible, exceptional results. We see it in the record $11.9 billion backlog, giving that amazing visibility. We see it in the explosive margin expansion, nearly doubling historical profit levels. And we see it in the best-in-class returns on capital, which really affirm its transformation into a high-quality, high-return service provider. On paper, and based on recent execution, EME looks like it's firing on all cylinders.
The risks are real, and they seem primarily operational. They're centered almost entirely on these capacity limitations, dominated by that skilled labor shortage we keep coming back to. And this is where management's own investments in productivity become really critical. EME has been talking a lot about and investing in technology like virtual design and construction, VDC,
Right, using detailed digital models to plan everything out before they even start building on site.
and also expanding their use of off-site prefabrication. Building complex components like electrical racks or pipe modules in controlled factory environments instead of on the chaotic job site.
And the goal of those technologies is fundamentally about labor productivity. They essentially allow one highly skilled supervisor or technician to oversee much more output, much more efficiently than traditional stick building methods. It's a critical strategy to mitigate that labor scarcity risk.
Okay, so let's leave you, the listener, with this final provocative thought. It really hinges on that tension between the overwhelming demand and the very real capacity constraints. Here it is. Will MMScore's aggressive and pretty advanced use of technology, things like VDC, offsite prefabrication, will that actually be enough to fundamentally overcome the industry-wide skilled labor scarcity? Or will that severe capacity constraint eventually, inevitably, force a slowdown in how quickly they can convert that massive, high-margin $11.9 billion backlog, ultimately challenging that premium 28x valuation?
That's the multi-billion dollar question right there.
Yeah.
That tension is absolutely the key thing to watch going forward. Thanks for joining us for the deep dive.
We'll see you on the next one.